So if you're a business owner in Australia and you're looking for legal ways to reduce your tax, I'm going to give you a few simple strategies that are going to help you. These are strategies I've implemented myself, and I'll show you exactly how to do it as well. So most of us don't have a great relationship with the taxman. We pay what we need to, but we only want to pay our fair share. And there are legal ways for you to dodge the taxman and make sure that you put more money back into your pocket. I'm going to run you through some of those strategies right now. So the first strategy is utilizing negative gearing. So the idea of negative gearing is that you acquire a property, an investment property that is rented out, and the costs associated with holding that property exceed the income that you receive from that property. So let's say, for argument's sake, the mortgage repayments are $25,000. Let's say the running costs are $5,000, your agent's fees, insurance, and so on and so forth. So that's $30,000 in costs. And let's say that you only produce $25,000 a year in rent. That means that that property is negatively geared by $5,000. Now, what the ATO allows you to do is to deduct that $5,000 from your taxable income and essentially claim a tax deduction on it. So in other words, you're probably going to get around about 30% back of that amount. Now, the thing you got to realize is that negative gearing means that you're losing 70 cents out of the dollar. So the reason why people do this is that they are buying high growth properties that appreciate in value at a rate higher than the cash loss that they're incurring for holding that particular property. Now, over time, it ends up working itself out in the wash. Now, my personal preference is that if I can buy properties that are positively geared or at least neutrally geared, then I get the best of both worlds, assuming that it's a good growth property and it also doesn't provide a cash flow burden. That's the best situation. However, for many properties, you're going to buy in Sydney, you're going to buy in Melbourne, you're going to buy in most of these capital cities. Even Brisbane's getting to the point now that most of the properties are negatively geared. It's great that the government gives us back a slice of that loss, so it does save us in tax. The second thing that you can do is that you can make salary sacrifice contributions to your superannuation. That's also referred to as concessional contributions. So a concessional contribution is a pre-tax contribution to your superannuation. Now, at the moment, you have the ability to put $27,500 a year into your superannuation fund as a pre-tax or a concessional contribution. And all of those contributions are tax deductible, meaning that it will reduce your assessable income in a year that those contributions have been made. Now, the thing to consider here is that depending on your age, you're not going to be able to touch your superannuation until you're at least 60. That is preservation age at the moment. So if you're young, like me, 34, and making aggressive additional contributions to super, while it's great for tax, may not be the best thing for you to do because that money is going to be locked up for potentially 20 or 30 years. So you've got to weigh up the tax benefits associated with putting that money into superannuation compared to paying the tax and using it to achieve other goals. For example, saving up for property deposits, investing it in family trust or something like that. Although you're going to pay more tax, you have access to those funds in that period of time before preservation age. The third one is another superannuation strategy, and this is a really good one. And we refer to it as the catch-up concessional contribution. So if your superannuation balance is less than $500,000, you have the ability to catch up for any unused concessional contributions that you have not paid over the previous 5 years. Now, let's say, just to get my numbers round, that the contributions cap is $27,500 for the last 5 years. And let's say that you'd only contributed $10,000 a year as part of your 11% that you've been putting into super. You basically got $17,500 for each of those years that you can contribute in one go. Now, where this is a really cool strategy to use is whereby you've sold a property or had a capital gains tax event. And in the year that you've made that capital gain, we make that contribution to your superannuation and ultimately offset some or potentially all of that gain that you would have had, meaning that we're reducing tax by a double whammy. So these are three simple strategies that you can utilize to minimize your tax legally. And the idea is that all of these are about building wealth and they are aligned with the appreciation of your asset base. Sure, there's other ways that you can reduce your tax by racking up your expenses, but if you're buying things that you don't need, it's not putting you in any better position. So really be mindful of strategies that you implement that are about reducing your tax, understand the implications, and make sure that you get advice. This is stuff that we do all day, every day. We help our clients model these various what-if scenarios and help them pick the appropriate one based on what's going to help them achieve their goals. So if you'd like to help with that, feel free to reach out to me and let me know if you've got any questions in the comments.